Do you take every bullish candlestick pattern as a sign that you should go ahead and click on the buy button? If so, sooner or later, you'll discover this move can lead to unnecessary losses. Sometimes, even a big green candle isn't necessarily a bullish signal. In this video, you'll learn more about the most common bullish candlestick patterns, how to interpret them, typical situations when bullish patterns aren't a buying signal. Before we delve into it, please remember to give a like to our video and subscribe to our channel for more useful trading tips. Let's uncover the most common bullish candlestick patterns and how you should interpret them. 1. The hammer. The hammer is a classic bullish candlestick pattern that has a small real body near the top of the candlestick with a long lower shadow. The color can be green or red, but a green body is more bullish. When this pattern forms after a downtrend, it hints at a potential reversal. 2. The bullish engulfing pattern. This two-candlestick pattern features a red candle followed by a larger green candle that completely engulfs the previous candle. 3. The morning star. The morning star is a three-candlestick pattern occurring after a prolonged downtrend. It consists of a red candle followed by a small candle, either green or red, that gaps below the previous candle, and then a large green candle that closes above the midpoint of the first candle. 4. The inverted hammer. Similar to the hammer, the inverted hammer shows potential reversal. It has a small real body near the bottom of the candlestick with a long upper shadow. The body color can be green or red, with a green body being more bullish. 5. The piercing line. The piercing line is a two-candlestick pattern consisting of a red candle, bearish, followed by a green candle, bullish, that opens below the low of the previous candle and closes above its midpoint. 6. The three white soldiers. The three white soldiers is a powerful bullish reversal pattern consisting of three consecutive bullish candles with increasing real bodies. Now, let's see when these patterns indicate a false bullish signal. Once you see a bullish candlestick pattern, if the following price action doesn't confirm the reversal, for example, prices do not rise or continue to fall, it might be a false signal. Also, the pattern should ideally be accompanied by high trading volume to confirm the strength of the buying pressure. Low volume during or after the pattern's formation may indicate weak buyer interest. If the bullish pattern forms just below a significant resistance level, the price might struggle to break through this resistance. In this case, the risk of a pullback increases, making it a less favorable time to buy. Another situation is in a sideways or range-bound market. Bullish candlesticks might lead to only short-term upward movements that don't result in a significant trend reversal. Also, look for overbought indicators. Technical indicators like the Relative Strength Index or Stochastic Oscillator showing overbought conditions might suggest that the asset is due for a correction rather than continued upward movement. Bullish candlestick patterns give you valuable clues to price action and market direction. But remember that successful trading means waiting for more robust confirmation, like increased volume, breaking of resistance levels, or supportive signals from other technical indicators before considering a long position. Start your journey to becoming a savvy trader with Altrady. Keep a watchful eye on these bullish candlestick patterns with our user-friendly platform. Enjoy a free trial to define your own candlestick patterns, backtest trading strategies, and experience unlimited free paper trading. Feel free to share this video with whomever you think will find this information useful.